In 1923, in a city called Berlin, a woman walked into a bakery with a suitcase full of cash. By the time she reached the counter, the price of bread had doubled. So she left the suitcase there and ran home to grab more money. When she came back, the suitcase was gone. The cash was still on the floor. The thief had taken the suitcase. So she left the suitcase there and ran home to grab more money. When she came back, the suitcase was gone. The cash was still on the floor. The thief had taken the suitcase. That's not a metaphor. That's what happens when money fails. Not when markets dip. Not when inflation rises a little. When money itself stops being trusted. And here's the uncomfortable question. If that happened again in any modern country, what would actually survive? Because history is clear about one thing. When money collapses, something else replaces it. The only question is what? And who benefits? Right now, most people assume money is solid, stable, backed by something real. But most modern currencies aren't backed by gold, or silver, or oil. They're backed by belief, and belief is fragile. We live inside a system called fiat currency. Fiat just means decree. Money has value because the government says it does. Quote, and because everyone else accepts that story, as long as people keep accepting it, the system works. When they don't, it breaks fast. Look at the Weimar Republic in the early 1920s. After World War I, Germany owed massive reparations. The government didn't have enough tax revenue, so it printed money. At first, nothing dramatic happened. Then prices began rising, then accelerating, then exploding. In January 1923, a loaf of bread cost 250 marks. By November, it cost 200 billion marks. Savings evaporated. Salaries became meaningless. Pensions turned into jokes. The middle class, the cautious, rule-following savers, were wiped out. But here's what's interesting. Germany did not collapse into nothing. Life continued. Shops opened. Trains ran. Food was grown. So what survived when money failed? Hard assets survived. If you owned land, you were fine. If you owned factories, equipment, or coal mines, you were fine. If you had foreign currency, gold, or access to real goods, you were fine. It was the paper claims on wealth that died. The same pattern showed up decades later in Zimbabwe. In the 2000s, the government printed money to cover deficits. Inflation reached 79.6 billion% month over month at its peak. That number is so absurd, it sounds fictional. But again, something survived. US dollars circulated informally. Gold, cattle, fuel, even. Prepaid mobile phone credits became a medium of exchange. When official money failed, shadow money emerged. Because trade doesn't stop. Human exchange doesn't stop. Trust simply migrates. Now fast forward to 2008. The global financial system didn't implode, but it came close. Major institutions, including Lehman Brothers, collapsed. Credit markets froze. Banks stopped trusting each other. And here's the part most people still don't fully grasp. Modern money isn't just cash printed by central banks. Most money is credit. When a commercial bank issues a loan, it creates new deposits. That's new money. Roughly 90% of money in developed economies exists as digital bank deposits liabilities on a bank's balance sheet. So when trust in banks falters, money itself shrinks. In 2008, central banks stepped in. The Federal Reserve expanded its balance sheet from under $1 trillion to over $4 trillion within a few years. It created reserves, bought bonds, injected liquidity. In plain language, it manufactured trust, and it worked. But it revealed something important. The system survives not because it's unbreakable, but because powerful institutions can rewrite its rules in real time. Now let's talk mechanics. Money today functions on 3 layers. First layer, central bank money reserves and physical cash. Second layer, commercial bank deposits, what you see in your checking account. Third layer, shadow money repo agreements, money market funds, short-term debt instruments used by institutions. The public mostly sees layer 2. The real fragility sits in layer 3. In 2019, the US repo market, essentially short-term collateralized lending between financial institutions, suddenly spiked to nearly 10% interest overnight. That's not normal. That's a stress signal. The system required emergency intervention again. Here's the uncomfortable math. Global debt today exceeds $300 trillion. Global GDP is roughly $100 trillion. That means the world runs on leverage about $3 of debt for every $1 of output. Debt is future money pulled into the present. Long as growth outpaces interest, it's manageable. When it doesn't, something breaks.
If confidence in sovereign debt falters, currencies wobble.
If currencies wobble, capital flees. Or if capital flees, governments respond, often by printing more money. And we loop back to where we started.
So what actually survives?
Let's strip away theory. In every historical monetary breakdown from Argentina in 2001 to Venezuela in the 2010s, 5 things consistently hold value: real assets, energy, food production, foreign hard currency, and networks of trust. Notice what's missing: stock certificates, pension promises, long-dated bonds.
Paper wealth is leverage on stability. When stability disappears, so does the leverage.
There's an irony here. There's an irony here. Financial assets outperform everything. Equities compound. Bonds yield. Real estate appreciates. In unstable times, simplicity wins. Cattle beat currency. Fuel beats bonds. Connections beat contracts. But here's the twist. Most survival narratives ignore. Total collapse is rare. Monetary systems don't usually vanish overnight in developed economies. They erode. Purchasing power declines slowly, then faster, then suddenly. The US dollar has lost over 95% of its purchasing power since 1913, yet society didn't disintegrate, because the decline happened gradually, because productivity rose, because military and economic dominance reinforced trust, and because alternatives were worse. That last point matters. Money survives not because it's perfect, but because competitors are weaker. Now step back. We see rising sovereign debt, aging populations, slower growth, geopolitical fragmentation. We also see digital currencies, central bank digital currency experiments, private crypto networks. Every one of these is, at its core, a trust experiment. If traditional fiat weakens, capital will migrate. The question isn't whether money can fail, it's whether the failure is localized or systemic. Localized failures create opportunity for outsiders. Systemic failures reshape power structures. When the British pound lost reserve currency status after World War II, it wasn't just a currency event. It was a geopolitical shift. The US dollar replaced it because the United States held industrial dominance, military power, and creditor status. Reserve currency isn't about patriotism. It's about balance sheets and battleships. So what survives when money fails? Productive capacity survives. Energy infrastructure survives. Land survives. Land survives not because it's magical, but because it's scarce, portable, and globally recognized. Strong states survive. Weak states fracture. And elites with diversified assets almost always land on their feet. The middle class, dependent on wages and savings denominated in local currency, tends to absorb the shock. That's the pattern. It's not because it's fair, because of how the plumbing works. Money is a claim on future output. If the claim weakens, the output doesn't disappear. It just gets repriced, sometimes violently. So when people ask whether money could fail today, they're asking the wrong question. The better question is, which layer fails first? Is it currency, purchasing power? Is it bank solvency? Is it sovereign credit? Or is it trust in the institutions themselves? Because once institutional trust fractures, recovery becomes political, not just financial. And political resets are rarely gentle. Here's the uncomfortable ending. If money failed tomorrow, supermarkets would still have food for a while. Electric grids would still function for a while. Companies would still have equipment, employees, and supply chains for a while. The real economy doesn't vanish. But pricing would become chaos. Contracts would be renegotiated. Savings would be tested. Power would consolidate. And something new would emerge as the trusted unit of exchange. Maybe another fiat currency. Maybe a commodity-backed system. Maybe a digital hybrid controlled by central banks. History doesn't give us a script, it gives us patterns. The pattern is this: when money fails, wealth doesn't disappear. It changes hands. So the real question isn't whether the system is fragile. It's this: if trust shifts suddenly or slowly, are you holding a claim on paper? Or a claim on something the world cannot function without? Because when belief breaks, only the indispensable remains, and we don't get to choose whether that moment comes, only whether we understood the rules before it did. Thanks for watching. If you found this valuable, consider subscribing.